themes such as Make in India, ease of doing business, Skill India, early dispute resolution are all extremely laudable and are really a must-have if the country needs to grow at a consistent level. But the reality is that these are still work in progress. Each one of them have achieved a certain takeoff and still far from being completed. So both the industry and the government and we as a nation need to figure out a way for, in an early manner, complete these themes into a finished product and be able to take advantage at an industry level, at a governmental level and at a country level. The speed at which we are able to do this will determine how far we as a country, and that includes the industry and the government, are able to leverage on the growth opportunities.
I think the audio is not going there. The cameras are coming.
So what am I supposed to do?
Would you like to do it from here? No.
I need to see the slide. So I can hold the mic.
Vinay? No, I can.
No, I can hold the mic. I can hold the mic.
That is fine.
Are you able to hear me now?
Yeah.
Okay, I think those in the room are fine. I don't know about the media otherwise. Okay, what I was trying to say was if you want to encash on the opportunities the country presently has, which to our mind is very exciting and promising, it's very important to bring to quick resolution some of the headwinds, be it Make in India program, be it Skill India, be it ease of doing business or early dispute resolutions. So having said that, let's look at how L&D has performed and dealt with the opportunities and the challenges during FY17. The usual disclaimer on the statements that could be forward-looking in the course of this conversation. The performance highlights in summary is that we have had a 5% growth in the order intake for FY17. Consequently, the order book has grown by 5%. The revenues have grown by 8%, and what is interesting and encouraging is the EBITDA has also grown by 6% alongside the 8% revenue growth. The recurring profit after tax, excluding the exceptional, has grown by 43%. And we've been able to achieve significant reduction in the working capital during the current year, bringing it down on a consolidated basis from 23% to 19%. And consequently, we've been able to lower the consolidated debt equity from 1.85% to 1.75%. Looking at the financial results, we have bagged orders worth 1,43,000 crores during the year, and this is a 5% growth over the 1,36,000 crores that we reported in the year that went in FY15. We have growth in the domestic orders, as you can see, by 10%, from 927 billion rupees to 1,015 billion rupees. But there has been a 5% decline in the international orders from 434 billion rupees to 415 billion rupees. So on a blended basis, the orders that the company has won during FY17 increased by 5%. When you look at the order book, including the orders that we have received in the current year and excluding the execution that we have done during the course of FY17, the order book stands at 2,61,000 crores. Up 5% from the 2,49,000 crores of the previous year. The slowdown in the international orders is a combination of the position of those markets. As you might have observed, that the Middle Eastern markets, after the oil price decline, have got into a certain conservative mode in terms of fresh investments, and we have also gotten very selective in terms of which orders to participate and which not to. So the selectivity as well as the slowdown has led to, in a manner of speaking, a deliberate lower intake of international orders. But the encouraging part is led by the quarter 4, which is the most recent quarter that we have completed. The domestic orders have grown by 30% in quarter 4, and on a year as a whole, the domestic orders have grown by 10%. And that we hope could be a beginning of an investment cycle which will enable us to utilize our capacities better going forward. The order inflow largely was contributed by infrastructure sector. 55% of the orders came in from the sector. Hydrocarbon joined the party this year. We won some significant orders in the international markets, particularly in Saudi Arabia, the share of hydrocarbon orders is 13% to the total pie of orders that we have won during the year. The services business grew well by about 10-11%, and they've contributed as well. Power sector has been a bit of a disappointment. The opportunities were very limited, so we couldn't add to the tally through the power sector. However, heavy engineering, which is residing both the defense piece as well as the process plant and nuclear piece, have done well during the year, and their share of the total order pie is 5%. Electrical business has been steady at 4% of the total pie. We spoke about an order book of 2,61,000 crores, and that gives us confidence about the revenue visibility for the next couple of years. And the composition of the order book has infrastructure at almost 1,90,000 crores. The lion's share of the book is from infrastructure projects. Hydrocarbon at 24,000 crores comes next, followed by power at 13,800 crores. Heavy engineering at 12,000 crores, and all the rest put together accounting for 14,200 crores. The performance of the company, the revenues grew by 8% at 1,10,000 crores as compared to 1,01,000 crores of the previous year. The manufacturing, operating, construction expenses have been in line with the revenue growth, growing by about 7.8% at 726 billion rupees for the FY17. The staff costs are 138 billion rupees, have registered a growth of 3.9%. We've been able to contain the increase in staff costs largely because of the productivity enhancement measures that we have been following and the digitalization initiatives that the company has been taking. This, coupled with the automation and the robotics that we are trying to use in our engineering and design, has helped us contain the increase in staff cost. The sales and administration cost at 70 billion rupees for the year records a 22% increase, and these are largely on account of the non-performing asset provisioning that the financial services business has made in alignment to the regulatory policy changes. And consequently, in a consolidated chart, we do have the additional provision made by financial services for non-performing assets escalate the selling and administration cost. The total operating cost at 989 billion rupees has increased by 8.1% as against 7.9% of the revenue. Consequently, the EBITDA margin declines by 10.3% to 10.1%, a 20 basis points reduction. But the EBITDA in absolute level at 110 billion rupees registers a 6% growth. It's gratifying to note that the efforts that the Treasury team has put in trying to reduce the finance cost has borne fruit. We are reporting a 20% decline in the interest cost for the year FY17 at 13.4 billion rupees. It is occasioned by a larger cash flow helping us to repay some of the debt, as well as our ability to refinance some of the loans that we have contracted in the past. The depreciation at 23.7 billion rupees is up 32%. And this largely represents a certain asset restatements, value restatements that we had done under the Ind AS standards, as well as the restatement that we have done on account of the Seawood Mall, which we monetized in the course of the year. Other income at 14 billion rupees is up smartly at 55%, which reflects better treasury management. The profit after tax before exceptional at 59 billion rupees is up by 42%. And an exceptional of 1.2 billion rupees takes the reported profit at 60.4 billion rupees at 42.7. The exceptional income largely represents the gain that we made at a consolidated level on sale of our insurance business, reduced by the impairment that we have made for our concessions business. We have the segment composition, which most of you are familiar with. We are into infrastructure, power, heavy engineering, electrical, hydrocarbon development projects, technology services and IT, financial services and the rest. Looking at the segmental performance, infra segment has grown revenue by 8% during the financial year at 528 billion rupees as compared to 488 billion rupees. Of the 528 billion rupees, 176 billion rupees, roughly about 25%, came from international projects that we are executing under the infrastructure segment. The EBITDA margin declined by 1% from 11.2% to 10.2%, largely reflecting the headwinds in execution. Normally, our accounting charts require us to capture the costs incurred through the overstay, and the reimbursements that happen at the end of the contract will provide relief for the costs booked now. So we do expect on satisfactory resolution of these projects, these margins could get back what it appears to have lost in FY17 over FY16. In terms of power, the sector has been beset with a lot of challenges. The opportunities are limited. The capacities that we have as against those opportunities are considerably higher. So there is intense competition for the limited opportunities. Consequently, the revenues from the segment grew by 8% on the basis of orders that we had received in the past years. In the current year, we have not won anything significant in power other than about 2,900 crores of orders. And the EBITDA margin is reflective of the competitive nature of the industry as it stands today at 3.5%. The profits do not reflect the profits that we make on the boiler JV and the results of the turbine JV, because these are regarded as joint ventures and are consolidated only at the profit level and not at the EBITDA level. The hydrocarbon segment has had a complete turnaround in its fortunes. It's done very well in the current year. It bagged 18,000 crores worth of orders. On the back of executing some of those orders, including those won last year, we had revenue of 95 billion rupees, which is up 13%. Much of the revenue are coming from international contracts because half of their business lies anyway outside of Indian region. So 46 billion rupees out of 95 billion rupees is on account of international contracts. The fact that we are leaving behind for sure the ills of the legacy projects that we contracted 3 years ago, and we have been going through the pains of reporting the cost overruns in those projects in the last couple of years, is evident from the fact that the EBITDA margins have moved up from 0.6% to 6.8% in the current year. Heavy engineering business has had a good year insofar as defense order is concerned. After a long while, we did get the benefit of a large defense order. Consequently, the orders that we have picked up will augur well for the revenue growth in the following year. But because we had a rather soft year in the previous year on account of fresh orders, be it in process plant, be it in nuclear plant or in defense, we had an opportunity to report only 3% growth in the segmental revenue at 30.84 billion rupees. Here again, 35-40% of this business is in international markets. So consequently, international revenues are 11 billion out of the 30 billion rupees. The margins are healthy at 19.9%. These are more truly reflective of the margins of the high-tech manufacturing that we do. In the past year, we were pushed back by cost overruns and costs not reimbursed and liquidated damages on contracts that we had completed in the past year. Since those have gone out of the books, we are now witnessing a rather healthy and more like routine margins for the heavy engineering business. With the defense order having been bagged in the fag end of the FY17, we do expect the sustainability of the margins in the following year. Electrical business has had a very flat year. It had 46.47 billion rupees as compared to 46.29 billion rupees in the previous year. The sector as a whole has been pushed back because of low demand from the industrial segment, agriculture sector not listing as many switchgear products, and a slump in the realty markets. So consequently, the company has done well to stay on trajectory in terms of revenue and has maintained its market share. The international revenues for the business out of the 46 billion rupees is about 14 billion rupees. We have factories in the Middle East which wins contracts and which record these revenues. This is in addition to the units that we have in Malaysia and Indonesia for medium voltage switchgear. The EBITDA margin has moved well from 12.5% to 15.1%, largely due to the improved product mix as well as the cost efficiencies that we have been pursuing to make this business more attractive. Information technology and technology services we report together, even though they are two listed companies. For segmental purposes at a group level, we report this as a common segment. We have had a 10% growth in revenue in rupee terms at 97 billion rupees, and much of this is anyway from international markets because most of the clients of these businesses are international companies. The EBITDA margins is healthy at 21.2%, and the profit margins are about 15% are healthy as well, and you would have had an opportunity to look at those results when those companies announce their results. The important part is there has been a fairly balanced growth of portfolios in terms of revenues, as well as the ability to improve the manpower utilization from 72% to about close to 80%. Developmental project business, we have power development business where we have an Nabha thermal power plant operating. We have Hyderabad Metro, which is under construction, and Katupalli Port, which is under disinvestment process. You might note that the revenue of the development project does not include IDPL, which is road concessions and a transmission line concession, because by shareholding structure with CPP-IP, they are a joint venture and not a subsidiary. Consequently, under the Ind AS consolidation rules, we cannot add the revenue of IDPL, but we recognize the profit or loss out of IDPL at the PAT level and not even at the EBITDA level. So while we call this as developmental project, this excludes the results of those revenues as well as transmission line revenues. The segmental revenue at 40 billion is down at 7%, largely because we grew Hyderabad Metro revenues a little larger last year because of the progress that we achieved on construction. This year, as we are getting into the home stretch of the project completion, the revenue accretion does get moderated. The EBITDA margins at 2.3% reflect the strain that we are having on the thermal power plant, where certain disputes have arisen on the PPA, and these are sub judice. And pending the outcome of these judicial pronouncements, we have stopped recognizing the revenue on account of disputed claims, and which actually is the right thing to do under the prudent accounting policies. So consequently, there is a EBITDA margin there. But we do hope that as these resolutions are achieved, we should be able to get what is rightfully due to us under the PPA. Financial services business has done well, and like in the case of IT and technology services, you would have had an opportunity to look at their results as well. Their revenues at 85 billion rupees have grown by 11%. Their loan book has grown by 11% as well. The EBITDA margins at 10.1% is a sharp drop from the margin of the previous year, largely because of the provisioning, and some of which is accelerated, that the business has made for non-performing assets in the quest to make the balance sheet of this business stronger. All the rest of the business that we run, be it realty, be it minerals, metals, material handling, be it industrial equipments or shipbuilding, are classified under other segment. The segmental revenue at 98 billion rupees is up by 12%, and the EBITDA margins are at 10.9%. The segment suffers from the low industrial growth and the weak demand scenario that prevails across most of the products. The demonetization did real estate business, and though the prospects are beginning to improve, much of the last year since November saw a decline, and that is reflected in the results as well. And the shipbuilding facility that we have put up, we continue to await defense orders. We did think that during FY17 we could benefit from some of the ordering. The ordering has got delayed, and we hope FY18 has something different to report insofar as the capacity utilization of shipbuilding is concerned. We also, in the course of the year, did write down the inventory of ships that we were carrying to reflect the true value of the assets that are embedded in our books. So with this, I conclude the presentation, and maybe we'll request Mr. Nayak and Crore to join us for a Q&A. Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNow Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.